Today we're going to talk about an investment hack. Wall Street for many years, it's almost decades now, has been suggesting to invest your hard-earned retirement money in the S&P 500 almost entirely. The stock market is the thing. If you put 100% of your money in the stock market the last 20 years, it worked nicely. You made about 5.8%, but you had to weather 4 extraordinarily bad periods of drawdowns of pain. 2000 to 2003, where the stock market fell almost 40%, and then 2008, when the stock market from the high to the low fell almost 50%. And since then, it's been reasonably smooth sailing. But at the end of the day, these poor periods really destroyed the investment returns. And that's before any fees. If we added a fee, which is typically around 1% on Wall Street today, it reduced the returns. And we ended up with about a 4.8% annualized return. And that's being 100% stocks. Funnily enough, if we went to an institutional mix, which is approximately 60% in the stock market, 40% in the bond market, the returns on the poor years were much better. The returns on the good years were not quite as good. But overall, the rates of return were slightly better than being 100% stock. Now imagine if you could tweak it and hack it using index funds and funds that have had long track records like Vanguard and the Fidelity Contra Fund. But by just tweaking a couple of things, you could get significantly better returns. And we've come up with a portfolio called the Pentagon portfolio. And basically, over the same time periods, we've been able to generate almost an 8% rate of return. And if we change the advisor fee from 1%, which is common, 1% on a 60-40 to 0.5%, which we think is reasonable, the returns get even higher. What's important is the statistics. Basically, what we look at is the beta of 100% in the stock market is 1, which is the risk of the stock market. If it goes up, you get all of it. If it goes down, you get all of it. In a 60-40 mix, if the stock market goes up, you're getting around 65% of the return of the market. If it drops, you get about 60% of the downside. We're looking for about a third of the risk of the downside if the market drops. Now, these are historical figures. This is what's occurred the last 20 years. Certainly, we don't know what's going to happen the next 20 years. But wouldn't you take a portfolio that looked like the orange versus the green with just a simple hack and half the expense? If you're interested in getting more information, then hit the link below and we'll get you some more now. We can do a side-by-side comparison versus your current portfolio and a fee analysis where we can show you significantly how to cut the fees in your portfolio and maybe even your company's 401k programs. Take a look. We'll have a little bit of a call, and certainly we can give you a good second opinion. Thank you so much.